Welcome, welcome, welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, the number one value investing podcast in the world. Today, March 30th, on a Monday, coming at you with my co-founder on air, Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great for everybody else as well. Hey, if you are watching us on YouTube, hit that subscribe button, thumb this video up. Views are going up. We're very happy about that, and we are going to continue to pump out content. If you're not following me on Twitter, you definitely should be at Focus Compound, because days like today, I tweet out that we're going to be doing a Q&A after the close, and we're going to answer every single question that comes through. So if you want to be on the lookout for that in the future, obviously since we're doing Monday through Friday now, we're looking for a bunch of content, and we want to make it as actionable as possible, which means doing as many podcasts as we possibly can for our listeners and talking about what they want to talk about. So follow me on Twitter at Focus Compound. So Jeffrey, let's just roll into it. I'm sure there'll be new ones that come for it, but if you don't want to answer anything or whatever, we could, kind of go from there. But I'll just read them off to you. First question says, feelings on tobacco at these reduced prices.
I think some tobacco stocks are interesting. We talked a little bit about Turning Point brands, things like that. One thing to be a little cautious about is there is potentially some risk to vaping, and some tobacco stocks also own vaping things because of coronavirus, because there's some things that people have vaped in the past that have caused damage to their lungs in a way that's different from tobacco use. So, which was unexpected. So if there's stories about that and stuff, that would be an effect on younger people that would be worried about it. So just if you hear things about like some young 20-something-year-old person dying of coronavirus and that they think it's related to vaping, that would probably hurt vaping. But for tobacco, generally, it's a long-term use problem. So the people dying from it will be people who've been using tobacco for a while, not new users.
Mm-hmm. So, other than vaping, would you consider like an Altria or one of those companies, Philip Morris?
Yeah. I would probably be looking more at the ones that are less into cigarettes, but yeah.
Got it.
We've talked about Turning Point brands and Corellia tobacco before. Those would be two obvious ones to look at.
Mm-hmm. Got it. Next question says, why does Geoff hate Jim so much?
Well, there are three answers to that.
He's still very, very offended by the Jim comments from last week.
One, I don't go to gyms. Two, I just meant specifically about the spreading the virus. So I wouldn't be surprised if gyms are shut down throughout 2020 and 2021 in different places, maybe open up for a little while, then shut down again. And then gym stocks. I actually did write up 2 gym stocks before, and one of them did okay, Lifetime Fitness. It was taken private, but in general, as stocks, I don't really like them because they tend to borrow a lot of money in the form of leases that they have and stuff like that. Gyms also have very, very poor customer retention rates. Health things in general have this issue of customer retention. So a lot of people pay for, I mentioned that pornography will go up in this people staying at home. Well, no one pays for a subscription to a porn site and doesn't use it, but a lot of people pay for gym memberships and don't use them. So that causes a problem for, when you have a downturn like this or something, people quickly come off diets and come off going to the gym and stuff. So as a business, it has poor retention rates. Personally, I don't go to them.
Are you speaking from, from your experience or just generally?
I've never had a membership to either.
Okay, got it. The next question, are you looking at any oil companies? Thoughts on buying 100% of a small private business? Anything that you've considered?
I don't think we are looking at any oil companies. No, we're not. And we have not thought about buying 100% of a small private business. Just because that's not what we do. Also, I don't think that prices of private businesses have declined as much as prices of public companies.
No, how do you get those statistics? Why do you feel that way?
Just because there haven't been deals. Maybe there will be eventually, but that tends to be the case early on. We'll see. But the stock prices adjust a lot faster. So, we'll see. I think there'll be distressed things and stuff. It's not something that we do in the fund or anything like that, though.
Got it. Thoughts on, is that Altius Minerals / EFB Corporation?
No, I don't have any thoughts.
Once you decide to buy stock, what's your process to accumulate shares? I can answer that. We've talked about that a lot. Usually it's all in and all out, right? And the reason you do that, Geoff, is so you don't get into sort of that, mind games and stuff like that, correct?
That is correct. In the fund and stuff, we buy fairly illiquid stocks. Even the managed accounts, we sometimes buy illiquid stocks. So our actual amount of time Buying it can be long. We might take months buying it, but that's just because there's not enough volume. But yeah, we commit to buying it in one go, and we commit to selling it in one go usually.
Got it. Next question. What do you believe you misunderstood most about the coronavirus pandemic when it first pinged on your radar, and why?
So just to be 100% honest about this, we are not at more cases or deaths or anything at this point in time than I expected. So it doesn't have anything to do with the spread of the virus. And when I say expected, I mean going back to the time of the first case in the U.S., let's say. So if we go back to the case of the first case in the U.S., which was, I guess, late January, mid to late January. So certainly since before February to now, there hasn't been any differences in the exponential growth or something that I expected. But what has been completely different is the government responses all around the world. So I didn't expect governments to respond the way that they have. And so the economic outcome has been very different than what I expected. So, yeah.
Yeah, unpack that a little bit. What did you expect?
I never expected anyone to shut down their entire economy. I didn't think that was something that anyone would do. So I expected quicker responses to do things. I literally expected them to shut down, to go into bars and pull out the bar stools, put up notices saying you're closed for 2 years by order of the local government, closed all gyms. I expected there to be things like maybe curfews. No nightlife. I expected things so that people that were at higher risk would not be able to go out at all, and things would be brought to them and stuff like that. I never expected the things that have happened with workers not going into work and stuff like that. So, and the reason for that is more complicated, I guess, but I didn't expect. The reaction has been very focused, understandably, because they're trying to minimize deaths right now on keeping there from being a surge of cases of people needing hospitalization in specific places early on when they don't have the capacity to deal with it. But I expected this to be more of a longer term thing, and that those kinds of things that they put in place all over the world are not sustainable for a very long period of time. So I just expected there to be very long-term restrictions of a lesser nature. I never expected them to do what they've done. We'll see. It's made a shift in society way beyond what I ever expected. And it's unlike any response to any pandemic previously that I'm aware of.
Do you agree with what they've done? If you were running the country, would you have done it differently? Or what are your thoughts on that?
I'm not going to second guess people who have to make tough decisions about this. And I think that even if the numbers suggest doing something else, I've said before that I think you can't sell people on that. So these people in all these countries are elected officials that rely on the support of different legislative bodies and things. And so even if they do believe that they should do something different, they can't realistically do it. They're not dictators. So.
Got it. Next question. How do you see oil companies recovering? Should the Russian and Saudis come to agreement anytime soon?
I have no idea about that. No, I don't see oil recovery remotely soon. I don't usually have comments about oil and stuff, but the amount of so oil grows at a very, very slow rate. Oil demand usually worldwide, it grows at an incredibly slow rate in developed countries, but it grows very, very slowly. The amount of demand that has been removed by the coronavirus is huge. It's bigger than anything oil's ever had before. So even if you didn't have problems between Saudi Arabia and Russia, even if there were really strong agreements on reducing output by a lot, you'd still have problems. I mean, I'm not saying I expect benchmark oil prices to go to zero or negative, but specific oil prices, specific products made from oil, and maybe oil in some cases, in some places, will probably go negative. You'll probably have to pay people, in some cases on cash basis, pay people to take it away. Because it'll become basically a waste product. There's just not enough storage and stuff in places. So I think it's pretty. I think it's pretty serious, and I think it's a demand issue.
Mm-hmm. I would agree with you. I don't think it's going to end anytime soon. Next question. Thoughts on IESC? Seems like an interesting underfollowed stock. Do you all do any trading or put on any hedges? Probably like with like calls and puts. If so, what? Oh, never mind. Because he says, if so, what instruments do you use? Thanks for the content.
We don't use any sort of hedges at all. We have never hedged stuff. We don't even hedge currencies. I suppose it's not impossible that we could hedge And it's not 100% possible we could hedge an exposure to something else in the same capital structure. So it's not impossible that we could buy something of a company like a convertible preferred stock or something and short the common stock, or buy stock in company A, which is owned by company B, and short company A. Own stock in company A that owns company B, and then short the shares of company B or something like that. So like I mentioned, Standard Diversified and Turning Point, we don't own those things. But if you did, and if you had wanted to, you could certainly have bought Standard Diversified and shorted Turning Point brands when Turning Point was pretty expensive, and then you take that short off when it gets cheap. We don't do that. We've never done that, but I can't 100% rule out we would do something like what I just described there. As far as shorting different stocks or putting on hedges that aren't related to the exact same company, I don't think we would ever do that.
Got it. Let's see. Next question: how to quickly determine if a business is asset light and capital light?
Well, I actually do it pretty simply by adding up receivables, inventory, and property, plant, and equipment, and then subtracting out working liabilities, which are accrued expenses and accounts payable. The number you get left after that, you then can compare it to things, most likely sales and gross profit and stuff like that would give you the most stable one over time. The easiest way, if you don't want to do that much work, is to go to like QuickFS and type in the name of a company. And if you see numbers that are very unusual returns on invested capital, the number you want is invested capital, not return on equity or something like that. If those numbers are extremely high, like they're 50%, 80%, whatever, or they're negative in years in which the company had a profit, which would mean that they have negative invested capital, then it's obviously very capital light. So the way to cheat is by looking at how high return on invested capital is. But if you want to really look inside the business, is what I just described about those 5 balance sheet items, and then comparing them to things like sales and stuff like that. That's the actual correct way of doing it, because that will be able to tell you if it's asset light, even in years in which it didn't really earn a lot of money necessarily.
Got it. Have you ever read valuation books by Downturn or the one by McKinsey?
I have read his website.
Yeah, I've been on his website.
Yeah, I've read his website a lot. I have not read the valuation book of either one. McKinsey has a well-known valuation book too. I've not read either one.
Yeah, I've read parts of McKinsey. I haven't finished it, or like all of it, but there's been chapters and stuff that I've definitely flipped through. And then for him, he actually has a ton of resources on YouTube. I think he actually has his classes up on there, so he obviously teaches at NYU, like a valuation class, and he has like the classes recorded and stuff up on YouTube, I believe. And I remember a few years ago, I definitely spent some time on there. So yeah, it's a good source to get all of his information is on YouTube, believe it or not. Next question: what are some key numbers you look at when valuing commodities? For example, production, inventory, price, etc.
We really don't look at commodities that can be traded globally or something. The only commodities that we've really been investing in and looked at would be timber, different aggregate stuff. So that's stuff like lime and cement, which is the next product up the line, and actually just like basically gravel and stuff. In terms of what we look at when it affects a business, honestly, we just look at the very, very long-term average real price that it's traded at. That's usually the most informative thing. So if for an investor, not a trader, if you want to look at is copper overvalued, is oil overvalued, it's generally the very long-term real price of it going back a long period of time. So we've looked at some other things. I mean, I did when I was writing up a cruise ship thing, I did look a lot into oil prices, and basically all I could determine is that if oil is much more than about $70 a barrel in real terms, this will change if there's a lot of inflation or deflation, but about $70 a barrel, if it goes much above that, then forces are going to come into play, which in a few years will cause it to come down. And if it goes much below $30 a barrel, forces will come into play that will cause it to rise. So other than that, I wouldn't say that that you can judge that well. We just don't invest in things that are sensitive to commodities that are traded around the world.
Next question: thoughts on Parks America's current situation with the virus? You want to answer that? Or your answer on that?
I mean, we own 17% of the company, so we don't comment on anything about Parks America.
Correct. Should beginner investors avoid investing in companies that mention EBITDA in their 10K? Is this a good filter? I would say no.
It's interesting.
I mean, it being an automatic disqualifying factor, I think would be. I don't think so. No.
No, I agree with that. I think it's often fine for a business to focus on EBITDA. That doesn't really bother me. There are some things, it depends on how they define the measure of EBITDA they use, and the less the amount of things they take out of their adjusted EBITDA would be more helpful. So how simply they explain it. We invest in plenty of companies that use the term EBITDA. So I wouldn't see it as necessarily a problem. I think a lot of adjustments to it can sometimes be a bit of a problem. But it's more that I would be cautious about anything that management points out as the way to value the company if you don't agree on that way. So I've seen that in many companies. I've seen free cash flow. Everyone loves free cash flow. But if management is trying to sell you on free cash flow as being the way to value their business, then you have to be a little more careful about free cash flow. So the same thing, if they're focused on EBITDA and analysts and stuff are focused on EBITDA, you want to look at a lot of other numbers too. Always be careful not to just focus on what management is guiding you towards. But other than that, no, I think EBITDA is okay to use.
How long have you hold the shares 2, 5, 10 years to get max out of it? So maybe he's just asking, what's your average holding period?
When we buy a stock, we look at it on the assumption we'll own it for 10 years. In reality, we tend to own it for shorter. I would say a long term for me has been about 7 years or something. We don't own things for a lot less than 3 that are successful, probably. We almost never own something for less than 1 year unless it was really a big mistake.
Mm-hmm. Who are some of the CEOs and people you would love to invest alongside? Maybe let's just stick to CEOs.
Okay. It's a hard question. So for me, I don't necessarily know. What about for you?
Well, I mean, it depends, right? I mean, like Todd and Ted, I would say I'd be definitely interested in.
Okay.
Who else? Bill Ackman.
In terms of investors, yeah. I mean, I said before that if I was going to give someone my money or something, it would probably be someone like Pabrai, because it's a strategy that's totally different from my own. So that makes sense. You'd want to find someone that you like who doesn't do the same thing you do. CEOs is hard for me because I tend to think that there are exceptions, but I tend to think that the results of a stock is has more to do with the industry that they're in and the business and the culture to some extent, rather than who's running it. But we own some stocks, and generally it is our policy to invest more in stocks where we like the management and to try to avoid situations where we don't like the management. But I've said before, of the stocks that we own, my favorite management is at NACCO, and it's a lignite coal company. So it will decline because of the industry it's in over time due to that, regardless of what management does. So if you take a really good CEO and put them in a coal industry, I don't know how well they'll do.
Mm-hmm. If you were forced to own a well-known large cap today, what would it be? And also, any thoughts on big banks here?
I don't know. I was thinking about that. So I have owned Omnicom before, and Omnicom is pretty cheap. I don't know if that technically counts as a large cap or whatever right now, given its price. I don't know where the cutoff is for large caps. But I don't know. It was a day or two ago. Let's see. So last week at one point it was trading at 8 or 9 times earnings. There'll be a recession in advertising, and it will be deeper than the one in the financial crisis. It may be shorter, but it'll be deeper. And so that's a bit of a problem. But you could have bought that at 11% to 12% earnings yield. They convert on an average year more of their earnings into free cash flow than 100%. So they have more free cash flow than earnings. And they use all of it to pay dividends and buy back stocks. So you would get about a 5% dividend yield. And then the rest of that amount, 5, 6, 7%, would theoretically be used to buy back the stock. So if the stock stayed cheap, you'd be getting earnings per share growth as soon as earnings per share recovered, or of 5 to 7%, probably, because that's how much stock they'd buy back. I don't know if they will keep buying back stock throughout a crisis, and their earnings will decline for a little while. they don't have growth going forward of a lot. But I think it's a safe company. So, and it's also, by the way, one of the more expensive ad agencies. So probably the 5 big ad agencies around the world would be a good investment. And the time to buy them could, I guess, be in the middle of an ad recession, or as people could see that you were about to go into an ad recession. Big banks, I don't have a lot to say about them. They're well capitalized. I'm maybe a little less optimistic about how strong growth will be. And I think yields are a little more difficult for them. So it depends on the bank. The yield stuff is a little more difficult for banks that have cheap deposit bases, which are usually the banks that I like. So this affects Bank of America and Wells Fargo and stuff. They are somewhat less valuable if the world is growing credit more slowly, and especially if yields all across the curve are lower for a long time. But the stocks have dropped a lot. So I think they're generally pretty safe. I think banks would be one of the last affected things of the economy. I mean, I think their borrowers will be, the stocks of their borrowers will be hurt a lot more before they will be hurt. So there are concerns about credit losses and stuff, but if they're experiencing credit losses that are meaningful to their capital positions, then already a lot of other industries that you're probably invested in have been hit a lot worse. So I think they're interesting.
Cool. Your top 3 companies or sectors to look at in emerging markets?
We don't invest. I'd say we don't invest at all in emerging markets. I'm trying to think of any case where we have. I think that the things I'd be interested in are the same sorts of things that have worked well in the US and the rest of the world. So just things that have had very high returns on equity for a long time. So that can be everything from entertainment to branded food stuff to whatever. It is a question I ask people from different countries all the time. I ask people from, people probably know that I worked with someone from Vietnam for a while. I always ask, what are the attractive companies in that industry and then in that country that have actual mind share and things like that. So the same things that worked from 1900 to 2000 in the developed world are the same sorts of things I'd be interested in, things with the potential to have good returns on equity for a long period of time and stuff. So yeah, everything from branded stuff to entertainment stuff to things like that. But you'd have to know what is appealing to the local culture and stuff, which I don't know.
Favorite investment book other than You Can Be a Stock Market Genius?
Why don't you take that one first?
Favorite investment book. I like Phil Fisher's book. Yeah, that's a good one. Which Common Stocks, Uncommon Profits. That's a good one. I'm trying to think. I haven't read an investment book in a very long time. Is it Dear Chairman by Geoff Gannon? That was a good one.
Okay.
I like Pobri's book. I like Pobri's book a lot, actually. What else off the top of my mind? I should have prepared more. I like Joel Greenblatt's Class Notes, even though that's not a book. Everyone knows I like that. I'm looking at my bookshelf right now. Quality of Earnings is a good book. Financial Shenanigans, that's another good one. But then I really like just business books as well, right? Andrew Carnegie book. I like the book on Rockefeller. Trying to think what else. Yeah. What about you? Oh, well, actually, the Warren Buffett Portfolio by Hagstrom's good.
Yes.
The Snowball, we talk about that a lot. Even though it's not like a technical investing book, I still think it's an awesome book.
Yeah, I think that the Snowball, actually, the chapters where he starts, basically where he starts work. Actually, I think the chapter is called Strike One. If you start with the chapter called Strike One and read on till through the 70s and stuff, that's a really good investment book. Actually, just studying what Buffett did from about 1950 to 1990 or something like that is probably about the best you can do. So in terms of learning from it, if you were just going to kind of religiously study one text, I would say that the one to do is those middle chapters of the Snowball. Really, those are the best in terms of if you could find out about his investments and how they work and stuff. I like Ben Graham's book, The Intelligent Investor, a lot. I like Security Analysis even more, but people don't like when I recommend that one. And there are other ones I like. I am a big fan of Peter Lynch's books. I think anyone could read those and get a lot out of them. There have been others that I liked, but are less popular. There's a book by John Neff. There's a book by, is it Bolton in the UK? There's a book, a couple others like that. There's the, is it Ed Wachenheim? He wrote one. I'm trying to think of it. It was what the name of it is though. Common Sense. Let's see. I can't remember. It had a name that plays off of one of the other well-known investment books. But anyway, that one is pretty good too. So those are ones that have a lot of different case studies. Mm-hmm. So I liked all of those, and there are probably half a dozen others like them that I've read over the time that I enjoyed.
Got it. Yeah, I would agree. Is carpet cleaning and coronavirus decontainment company React Group going to 10 bag? I have no idea. Never heard of that company. Have you heard of that company?
No, I haven't.
All right. For a private business owner, how much diversification is needed in the stock market? Is owning 1 to 2 stocks such as Berkshire and MKL enough? Is that Merkel?
I don't know the answer to that. That's a very good question. It depends on your risk tolerance and what your private business is. So, I mean, we talked about Landry's, right? So the owner of Landry's owns the Houston Rockets and everything. Well, obviously now, all of his wealth that isn't invested in something other than the businesses he himself owns is in jeopardy. Same thing with the owner of the Miami Heat, Mickey Arison. He made all his money in Carnival. Everything that he has in Carnival is in danger of going to zero. So if you can't live with that, then there's a fair amount of diversification that you would need in other things. So I don't. That's a very hard question to answer. You'll get richer over time by being in a couple successful businesses that you own in public companies, and then owning a private business. But I think that I would be careful owning one single insurance company or bank or something, because you have to watch it very carefully. But we had a question once before that was like, how much diversification do I really need? And should I buy a bunch of different, I'm thinking I want to own Berkshire and Disney and then all this other stuff. And I was saying, well, actually, owning Berkshire and Disney, it gives you as much diversification as most people would have in half their portfolio, and they're stronger balance sheets and stuff and stronger companies overall than what you'd replace it with. So it depends on the company, but I think Berkshire gives you a ton of diversification. I wouldn't put it all in one insurance stock or one financial services company of any kind, because you can, if management changes their approach and you don't realize it, if the culture changes, they can actually go broke pretty fast. It amplifies management's aggressiveness or conservatism a lot of financial services. So you can mess up Berkshire a lot quicker than you can mess up Disney or something. So that's my one caution with that.
Cool. Are you able to buy bonds or preferred stock for your funds? And have you been doing so? Are there any preferred shares in distressed companies that look appealing? I'll just answer the first part. Yes, we are allowed to do that. Buy bonds and preferred stock. Geoff, do you want to answer the second part?
Yeah, we haven't bought any of those. Would preferred shares in distressed companies look appealing? I don't know, because I don't watch it very carefully. In 2008, 2009, they did, because preferred stocks had a tendency to be owned by institutions that were under pressure at the time. So it's possible. If there's any forced selling of it, if people just want liquidity and stuff, then they tend to sell things like preferred stock. Yeah, it's not owned by the general public.
What are your thoughts on alternative asset classes like gold and digital currencies?
I don't like them. I mean, if gold is very cheap or something, I'm not saying it would be terrible, but the problem that you have is it has to be very, very cheap, any commodity that you buy or something, because obviously there's you're basically paying a cost to carry it instead of the reverse, which is that it's sort of the same reason why I don't like shorting stocks and stuff, like as a hedge, let's say. If I thought the S&P 500 was overpriced, that might be true. I might have thought that in 2000, I might have thought that in 2008, I might have thought that, last year or whatever. But if you short it, you still over time have an expected return from it that's positive. So you have to have a pretty big decline to make that up for you. In these cases, you have to have a pretty high rise in assets like gold to make up for the fact that the compounding of stocks in terms of real terms is a lot better than gold. Gold is an asset that doesn't produce anything, and that gap over time is very, very harmful. If you're talking about wanting to hold gold instead of cash, or a mix of gold and cash or something as part of your portfolio always, then that's a different story. And I can't say that if you say instead of having 20% cash position all the time, you want 10% gold and 10% cash or something, if that makes you feel better about the fluctuations in your stocks and in your total portfolio, that's fine with me. It doesn't bother me. It's the same thing as if people want to hold bonds. They'll do worse, but they will help month to month things look better.
Got it. Any influential books that you've read, Geoff?
Have I read influential books? Some books I'd say have been influential on me. The biggest one is You Can Be a Stock Market Genius. In terms of looking at specific things. Yeah. How about you?
What about any non-investing ones where you just felt a spark of motivation?
No, that's never happened.
So this weekend, I actually read a book called The Four Agreements by Don Miguel Ruiz. Highly recommend that. That was a pretty cool book. Bit profound, a bit of a mind, you know what they say after that, a mind blown book. And I really liked it. So I thought that was, quite influential outside of investing. I mean, investing would probably be Stock Market Genius or, Snowball. I mean, that's, a very motivating book, I feel like, and a good book. But no, outside of investing, I said The Four Agreements by Don Miguel Ruiz. That's probably one of my favorite books I'll read every 6 months now. So definitely check that out. How far into the future are buyers looking to discount cash flow earnings today? To discount the earnings today?
I don't know the answer to that. This is the one that's confusing me a little bit about today's market. I don't know. I would guess very, very far.
Mm-hmm.
I mean, what do you think?
Yeah, I would guess. I would guess very far as well. Well, we've talked about a lot, right? Earnings for, in my opinion, it matters on the virus getting contained and everything getting back to normal, right? So I don't know how you want to handicap those odds. Assuming everything goes back to normal, 0% interest rates, massive stimulus, you can make the case that that's a friendly environment, but I'm not sure. I don't know. What do you think about that?
Yeah, I think a long time. I think they've been looking at a long time for quite a few years now. Yeah.
Mm-hmm. And then the last question says, will Geoff ever sit on the board of NACCO or some other public company? And then he said, P.S. I would suggest you read the book Why We Sleep, Geoff. I like that book, and get his circadian rhythm in tune with the daylights. A lot of people are concerned about your sleeping schedule.
Yeah, that's why I didn't want you to bring it up. But because people always have advice about those sorts of things. I'm sure, first of all,
Geoff does not like advice unless he asks for it.
I don't usually ask for it, so you don't need that qualifier. Let's see. Well, NACCO's not going to invite anyone on their board. Not that it will invite anyone, but it's a family company. They just added someone to the board who has a connection to the family too, again, and stuff. That's just not going to happen. It has the family controls the voting shares and stuff. It's not a board that is going to probably want a lot of outsiders on it, and it wouldn't be a board where it'd be helpful to have outsiders on it, really. Would I sit on any board? I really, really don't want to, but we do own we do run a fund that will sometimes own large parts of some companies. So I cannot 100% rule out being on a board. But if asked, I will definitely try not to serve. But if
asked, I will defer to Andrew, and if Andrew can't, then I will. That's what he's basically saying right now.
I would much prefer not being on a board to being on a board. But sometimes bad things happen at companies that you own a lot of and stuff. And who knows? It has happened before that investors who never wanted to be on a board have ended up on it. So I can't 100% rule it out, but I'm definitely not looking for it.
Got it. And any comment on your sleeping schedule?
No, I actually, it's pretty common for me to sleep reversed with the with day and night and stuff. If I don't use alarms and stuff, ever since I was a teenager, if I don't use alarms and stuff, I'll normally sleep reversing the time. So I'll generally go to sleep sometime always after 2 and before sunrise or something, and then wake up in the late morning or early afternoon or something. For lots of other people, if they slept without an alarm, I think that they would wake up in the morning times and stuff. I don't know what that's related to. There's some evidence of some issues with that with people with autism and stuff. I don't know if that's a connection to that or what.
Geoff, you definitely march to the beat of your own drum. What do we joke about? You got a way of ending the conversation without saying it. Be like, Geoff has a way of saying you're excused without actually telling you you're excused.
So, all right. So, are we? Do we have another topic that we need to go to?
Yeah, we can. Yeah. So the last part. So, and I thought this was actually good to go over because, a lot of people have been asking you recently, right, and me, and we got a couple of questions of, is this a good point to buy blue chip stocks and stuff like that, right? Or larger companies. Like we had a question, if you had to buy one large cap stock, what would that be? And the question that got sent out today, again, go to focuscompounding.com, enter in your email to get this in your mailbox, or follow me on Twitter every single day, Monday through Friday. Somebody asked you, in today's market, shouldn't I just focus on blue chip stocks instead of overlooked stocks? And he says, hi, Geoff, on regular days, you're focusing on overlooked stocks. Makes much sense to me and is the right place to look for good companies at a decent price. But in this market sell-off, wouldn't it be better to buy blue chip stocks such as Nike, Disney, BRKB, etc., if they fall to the right price? And before you give your whole explanation, your short answer, was you can buy stocks everyone ignores or everyone hates. Today, there are a ton of well-known stocks everyone hates. So tell me about that, Geoff.
Yeah, so a long time ago, I wrote something where I talked about that there are two kinds of bargains that you can have in stocks. Stocks, you can either get bargains because there's contempt or bargains because there's neglect. And that's the two reasons I give here. And so what we do at Focus Compounding is focus on overlooked stocks. So we look for neglected stocks, not necessarily stocks that people hate, but stocks that a lot of people don't know about or maybe wouldn't buy because they're illiquid or whatever, not because they dislike the business or are worried about what's about to happen to the business. So that, however, is not the only way to make money. You can definitely make money, and this is how all the big cap managers and stuff do make money, by buying stocks that are temporarily disliked, so contempt. And that's like, say, buying oil stocks right now, right? Being a contrarian and finding the best oil company for the long term and buying it at the moment where everyone hates oil stocks or hates restaurant stocks or hates airlines or whatever. So there's a lot of opportunities for that now. Historically, I'd say I don't know that you'll get better results in big stocks than small stocks right now. Small stocks actually have dropped a lot in some cases. But if you're looking for really good returns, it's much more possible to get them in big stocks in moments where there's a panic and where there has to be some deep amount of concern, either specifically about the company you're investing in or about the industry it's in, or the country it's in, or just the general market. And right now we're in the general market, but we're also sometimes specifically in certain industries that there's a lot of concern. So it is a chance to buy stocks you never thought you'd get the chance to buy some of the best companies out there now. Whereas in the later stages of a bull market, they're usually very, very expensive. And I just talk about how in 2009, in the first few months of 2009, I did buy some bigger stocks or stocks that were big for me. I bought IMS Health, which was only a couple $1 billion stock, a couple $1 billion market cap company at the time, probably. So not what people consider big. But I also bought Omnicom at that time. And I bought Berkshire. This is the only time I owned Berkshire. When there was a whole big thing about bank stocks to some extent, but especially energy, going back to the last time that oil prices declined a lot, I bought Frost, which is a very big bank in Texas. So I think on an average day, it's hard to buy something like Frost at a cheap price, something like Berkshire or a stock like that. But I think it's very possible if there turns out to be some panic in the market generally, or specifically in that industry, or even specifically in that company, like if there's a scandal or something. And that's how Buffett tends to do it. He looks for companies that are having a temporary problem that they can overcome. That's how he got a great deal on Geico and things like that. So
American Express.
Yeah, American Express with the salad oil scandal, sure. And even little things like when he bought Disney for the partnership, the market knew that there was no way they could top the box office receipts they got from Mary Poppins. So they were going to decline their earnings, the next year. And so sometimes it's better to buy a stock when that kind of thing is baked in, when they know that it's going to be a bad next year. So when I say things like, there'll be an online ad recession, that doesn't mean don't buy Google and Facebook. It means that could be the opportunity to buy it, because if everyone else is not used to the idea that the growth trend ever has this real sharp decline in some of their metrics, so things like revenue per user and stuff getting bad, it could mean that it'll scare out some of the people who are more growth-oriented compounding for a long time and have been used to certain sort of results in those companies and now are going to see different results, that could be the big moment to buy those stocks. So I'm not negative on stocks because I think they're going to experience a recession in their industry. That actually can be the time to buy a stock which was otherwise had too much, too consistent optimism in it. You know, that's the problem with a lot of big stocks, is really just consistently good results, these blue chip stocks, because it means you don't get dips to buy. And now you do.
Mm-hmm. Cool. Well, I mean, are there any qualities of those type of businesses that you would look for then? Is it really just, sort of going into it knowing that next year or maybe next 2 years won't be as good, and then trying to, I guess, handicap if that's baked in, and then, looking to buy it? I mean, what would you look for?
I'd look for three things, I guess. So the three things that I would look for are, one, when you have a recovery, the 10 years after that recovery potentially could be really big for the company. So high returns on equity, high potential runway for growth, things like that the returns will be really big. When we talk about things like Geico, American Express, Disney that Buffett bought, it's not just that these were momentarily unpopular stocks. They had a huge runway to grow amazingly in the future. So you want to buy something like that, and not really something like I was talking about Omnicom or something. Those ad agencies don't have a big runway for the future. So you have to buy them very cheap if you're going to get the best results from them, as opposed to things like Google and Facebook, and especially something like Amazon. But I would also say you want a really strong balance sheet situation, and particularly how the debt is spaced out and things like that. So sometimes, if you have a term loan that goes over 5, 6, 7 years that you pay monthly, that's very different from having it all in other things. Now, commercial paper and stuff might be fine now because there'll be government intervention, but you just want a very strong balance sheet. So probably, I think all airlines will go broke, but if I had to pick an airline, I would start with Southwest or something. And that leads into the third one, which is management and culture that can get through times like this. So that's why it's attractive to look at something like Berkshire, because you have more faith in them handling situations like this. In airlines, it would mean Southwest, because they're the only airline that historically has been run in a way to be prepared for bad times. They're not prepared for this time, though. But otherwise, they're prepared to survive recessions and things like that, whereas the other airlines historically hadn't been. So you want to look for that company that is realistic about what they're facing, And so I wouldn't want to be I don't want to be in industries where they keep saying strange things about how quickly they're going to get out of this and whatever, because even if that's true, that shouldn't be how they're planning and thinking. Their contingency plan should be for the worst case possibilities, and you want that. So, management that's focused on surviving this, balance sheet that's ready to survive this, and then after that's just business model that can really compound once you get back to normal times.
Got it. Cool. Well, I want to thank everybody so much for tuning in with Geoff and myself. We are going to make this a weekly thing. So be sure to follow me on Twitter at Focus Compound. If you want to receive this Focus Compound daily in your email box, go to focuscompounding.com and enter in your email for free Monday through Friday. And of course, if you're following us on YouTube, hit that subscribe button. I want to thank everybody so much for tuning in with Geoff and myself, and we will see you in tomorrow's podcast.